Hey everybody, Economic Ninja here on behalf of Wall Street Ninja. Today I am with Rob Brueggemann from CanStar Resources, and we want to talk about investing in the resource sector and what you may find as far as pitfalls and some advantages from his experience in the mining sector. And if you're new to mining investments, I think stick around. You're going to have some interesting lessons taught here. So Rob, thank you so much for jumping on.
Yeah, my pleasure.
Cool.
This is
So
stuff
now
I like
you're
talking about.
Yeah, and now you are sorry, I interrupt a lot. The Economic Ninja talks a lot. Sorry. Now, your background is interesting because you're the CEO of CanStar, but you have a background on the equity and investment side of the space, whereas a lot of CEOs in this space can have a geology background. Can we talk about the difference between those two backgrounds and how they might affect the outcome or the strategic path of an exploration company?
Sure, yeah, and I think there's some good distinctions there. So my background, as you mentioned, is equity research and then also a lot of investment. Um, Now it is, yeah, I also have an engineering degree, so I do have some technical background as well. But really, what drives me is I love research. I love understanding things, which probably ties back into that engineering background. And then I also love investing. And, obviously from an investment perspective, I like making money. So I was always intrigued by the mining space. I've invested in a lot of companies, both my own capital, and then I used to work for one of the big Canadian banks, and I used to invest their capital quite successfully, fortunately, and learned a lot along the way. But to answer your question about what are the differences, obviously, when you have a geologist involved in an exploration company, they're very knowledgeable about the rocks, different projects, analogies. So you got great technical expertise in that case. In my case, I'm looking at this from an investment perspective. So what I'm doing with CanStar is, believe it or not, it's an investment. I mean, I'm involved in this not because it's a job, it's because I put my own money in and I want to actively manage this and see it succeed. Um, with kind of a secondary objective, which is because I'd never been involved in exploration at this earliest stage, because it's very grassroots, I wanted to learn it as well because it's going to make me a better investor in the future. So that's what I'm doing here. But then, so really, I guess what I'm focused on, which isn't so much the rocks, is it's putting together a team that understands the geology and the technical aspects, and both the team, and I've got some excellent technical advisors as well. And then my job is really just raising money, setting priorities, focusing on the properties, which I think are prospective, and then letting the team do what they're good at, which is hopefully finding lots of gold.
I've noticed that where you have geologists that is running a company, they are focused primarily on the ground. They're looking literally down the entire time, finding the actual metal, whatever they're looking for, whether it be gold, silver, uranium, anything, cobalt, things like that. Whereas somebody with a finance background is looking at getting the story out, the advertising, making sure the financials are set up, things like that. So it's much different, depending on the background style of who's running the company. Now let's talk about what can affect the price of the stock, the company, where it's going. And let's look at like a large macro view, like let's say macro forces and the metal prices. How do those play into the price and how well or how poorly a resource company can do?
Yeah, it's probably the biggest thing when it comes to investment, is the macro forces, because as I'm sure you and your viewers are well aware, this is a hyper cyclical industry.
Yeah.
There are a lot of times where mining and exploration get no love. Metal prices go down a bit, and all of a sudden, people are dumping their shares, and in some cases saying, "Oh, well, we don't need commodities anymore," which is complete nonsense, obviously. But and then there are other times when it's in vogue and doing well. And those are the fun times, because then you can get spectacular returns and people keep coming back to it because of those returns, and as well as discoveries.
Yeah.
So yeah, I think as an investor, you have to know that backdrop, and maybe you have to have your beliefs too as to where do you go from here, obviously. But Yeah, that's absolutely key. You don't want to fight those macro forces. So right now, the US dollar is incredibly strong, and there are a host of economic reasons for that. But because of that, commodity prices are negatively impacted, including gold. And so, it's a big question is when does the dollar top out, which then is tied to interest rates and projections. But yeah, I think it's getting pretty close.
Yeah.
And when it does, I mean, that's going to be good for all the commodities.
I
So,
couldn't agree more.
yeah, so whether you want to jump in early or wait until you think you see that turn, hugely important. When it does turn, the dollar tends to trend. And so when it does turn, yeah, you're probably going to have a pretty good run, hopefully, for gold, silver, and all the other commodities. So that's a big macro backdrop, and the reason for that is we're really in a niche sector,
Mhm.
and certain times you get money flowing in, certain times you get money flowing out, and it's that swing of money that creates either supply or demand, and you want to get in or be positioned when that demand phase takes off.
Yeah.
So yeah, the macro is hugely important, and a lot of times, unfortunately, it seems to go against us.
Yeah.
So you have to maybe do your homework and pick your companies, etc., so that when the tide does turn, you're ready, you're positioned, and you can actually benefit.
I completely agree. And when we talk about the tide turning, it can happen fast. And that's why I always suggest to people if you're going to start looking into companies, especially in the mining sector, to just nibble, very small position, get to know the team, get to know the area, and then wait for that opportunity. Because you're right, as the dollar gets stronger, and it should get stronger if the Federal Reserve is able to keep raising interest rates. And that is the key word, if they can. If they can keep raising rates, it will cause the strength in the dollar, which will suppress commodity prices. But then when it breaks, and we know, like you said, the dollar trends, once it flips, it'll almost seem like overnight we'll start to see gold, silver, and other commodities take off, just like we did in 2008 when gold and silver made their bottom after Lehman crashed. So, okay, let's talk about risk mitigation because this is very, very important. I guess this actually is perfect dovetail into this when we're talking about taking small positions, really getting to know projects. Let's talk about risk mitigation when people are looking to invest in this sector. What could you suggest to people?
Yeah, so risk mitigation is huge. If you want to survive in this industry, you got to manage your risks. And so my background as an equity research analyst got me looking at what things I liked about companies. We put 12-month target prices on things, but then I got into the trading world, and that was really eye-opening and very beneficial actually because they taught me about risk mitigation. So things like live to fight another day, capital preservation, know when you're wrong, and that's huge. And in the mining space, what it you can both look at risk mitigation from a macro perspective as well as a micro.
Yeah.
And there are a number of things you can do. So obviously, the macro stuff we talked about,
Mm-hmm.
um, you know, don't try to fight the market. You're going to
Yeah.
lose.
Don't fight the Fed.
Um, don't fight the Fed. You're just not going to win. So unless you get lucky, it's going to fail. But so certainly, I mean, look at jurisdictions.
Yep.
There are certain jurisdictions that are bad.
Yep.
Things are always changing as well. So right now, for example, in Latin America, there are a number of countries that are trying to rewrite their constitutions. It can be left wing politics, it can be right wing. But when you get into an environment like that and you're uncertain of the outcome, my opinion is, unless you're getting a really good deal, it's just not worth investing in.
Yeah.
I try to know the countries I operate in as well. So I just stay clear of Africa. There are some good companies there, or sort of good countries and good companies there, but it's select countries. And then there's just a lot of places you don't want to go. And then, another couple of tidbits, I guess, is one, certainly on the geological side, it's always hard to assess, whether you're technical or not. There's limited disclosure of information. And so, the reason people say look at companies where you have high insider holdings, yeah, that's very true. I take it a step further and say, make sure there's actual skin in the game because there are a lot of companies where, people pick up a property, They take it public, but they retain, say, 25% of the shares, but they haven't really paid anything for them.
Yeah.
So, it's a punt, but it doesn't necessarily mean that if they lose, that it's going to hurt them. Whereas if you've put real money in, on kind of similar terms to what other investors are coming in for, then people are motivated to succeed. If it's a meaningful amount for them, they're not going to want to lose. They're going to want to do whatever it takes. So that's a good thing. And then the other piece of information put out there, especially because we do have so many times that this sector is bad. And this is something Rick Rule is very good at, is you get into financings if you can when the sector's out of favor,
Yes.
there's a lack of capital, and you do unit deals. You put money in, you get a warrant. And then what happens is the sector starts to take off. You don't know where the top is, or maybe you just take your capital out. So you buy a unit deal, you get shares and warrants, hopefully long-term warrants. Over time, maybe you get your capital out and you do it again. And what you can do over time is you can amass a portfolio with a large number of warrants. And that really, there's not a lot of risk to warrants.
Nope.
They may exercise or they may not get exercised.
Yep.
It doesn't cost you anything. But if they do, or if you get that timing right and the sector takes off, potentially you've got shares and you've got all these warrants, increases the chance of discovery. So I think that's something that's really good, where you've got a lot of exposure to the sector over time with not that much downside risk. So I'd say that's another one. And then a lot of us are in this for discovery as well. The 10 baggers, 20 baggers, 50 baggers, whatever. So you got to diversify, because
Totally.
that's part skill, part luck, just doing the work, etc. And yes, you want to get the returns, but you don't necessarily want to just put all your eggs in that one basket. So try to find good companies, good teams, good projects. Again, get warrants. And then the other thing is, in some cases when there is a good big discovery, get in early, or get in early on the discovery, but once there's confirmation. So I remember Great Bear was the company that kind of following, and they had some good holes, and he got into that early. I mean, he started to see drill results with pretty spectacular results, and you get in cheap. So buy it once you get that confirmation. Maybe it works out, maybe it doesn't, but at least if you have some drill holes with exciting results, and there's potential for there to be more, as opposed to if you're buying moose pasture and a dream of, this looks like it could be the next Dixie, that okay, at least put a couple of holes in it, show me that there's something there, and then I'd rather pay more for that certainty. And obviously you'll get more people coming in behind you as well and driving the share price up.
I couldn't agree more. First, diversification in the sector, multiple companies in the sector. You can't fight the macro, what the dollar's doing versus, what gold and silver are doing, or whatever commodity we're talking about. So diversification is key, not putting your eggs in one basket, just a little bit in each one. But also the team, like you said, is very important. To be able to have a team of winners, people like the geologist that has had a major discovery in their career. If you follow that type of background, you're going to get a winner. The reason why is a geologist that's already had a discovery, that's already had a major winner, already knows what it feels like, already puts himself or herself with a winning team, and they have already scouted that property out before it ever goes publicly traded. They know a lot, and they know what it's like to win, which means they don't want to be known as a loser. They want to be a winner, a winner, a winner. So I couldn't agree with you more. So Rob, in closing, is there anything you want to close out with in this video of teaching people what to look for when they're starting to invest in the resource sector?
Yeah, I guess one other probably important point is, as much as we all like the sector and want to find that next 10 plus bagger, I think the other thing that's important, especially if you're playing the juniors, is make sure it's part of a diversified portfolio. Only put in so much that you can afford to not necessarily lose, but maybe have aside in that diversified portfolio for a long time, because it can take a long time.
Yes.
But also keep in mind, you don't need to put in that much into each company to potentially have them turn into something still can be life changing. So that's, really what you're shooting for. It just, I think it's something people do wrong. Unfortunately, they get in, they get excited. Yeah, we see it. We saw with CanStar stock. Eric Sprott came in. Share price went from somewhere in the 20-cent range up to as high as 60 cents.
Yeah.
Yeah. So these people are all excited about gold prices and Eric Sprott coming in and the property exploration in Newfoundland. They waited around for a few months and then they got out. Um, that shouldn't be your time horizon.
Yeah.
If you're going to get into this, especially into something early stage, you may have to be there a couple of years. It takes time for the cycle and it takes time for the companies and these teams to do their work. So
I agree.
maybe you put it in tranches at different times. But yeah, don't buy it 60 cents right at the top. And then, when it hasn't doubled a month later, you say, okay, well, now I'm going to sell it at 30 cents. I mean,
I agree.
Yeah, you're not going to be in this sector for a long time.
Well, and if the Lassonde curve has taught us anything, it is that there is definitely a cycle to the starting of a resource company to a producing mine. And yes, that could be a long game. So I completely agree. Get ready, know where you are, know where your company is in that Lassonde curve. And that's going to tell you a lot of how long this investment could take to play out. Well, hey, Rob, I thank you so much for coming on. I really do appreciate it.
Yeah, my pleasure.
All right. Well, hey, guys, for the Economic Ninja, on behalf of Wall Street Ninja and the Dojo, we are out.